Hello, my name is Madelyn Suitor, and I'm a co-owner of the shoe company Happy Feet. Brandon Varnell and Christopher White are the other two co-owners of Happy Feet, and we are very excited to present our company to you today. Today, we will discuss our company's financial performance, our strategic vision, our strategies, our competitors, and our lessons learned. I would like to begin by taking a look at our company's annual total revenues. Looking at the chart below, it becomes apparent that our annual total revenues increased steadily but slowly from year 10 to 14, and then they took off quickly from years 14 to 19, and then they plateaued in year 20. In year 10, our total revenue for the year was $432,646. At the end of year 20, our annual total revenue was $1,926,258. Next, we're going to take a look at our annual earnings per share. Looking at our annual earnings per share, you can see that our company did struggle to increase the earnings per share for the first 5 years, but once we gained a better understanding, we were able to make the earnings per share increase fairly quickly from years 15 to 19. Our lowest annual earnings per share was in year 10 when it landed at $2. Our highest earnings per share was in year 19 when we were able to get it up to $35.73. Up next is the trends in the company's annual return on equity. Taking a look at our chart on our annual return on equity, you can see that we struggled a bit to get a handle on it from year to year. We were able to increase it for 2 years at the beginning, but struggled in the middle of the 10 years we operated. Our lowest annual return on equity was in year 10 when it landed at 10%. Our highest return on equity was in year 19 where it landed at 60.2%. We were able to increase from year 10 to year 19 a total of 50.2%. Next, I would like to look back at our credit rating. As you can probably tell from the chart, we were able to quickly get a hold of how to improve our credit rating, particularly from years 10 to 11. After year 11, we were able to keep our credit rating above an A, and we even had it at an A+ for about 5 years. You can see from years 14 to 16, we did struggle a bit with our credit rating, but we were eventually able to get it back up to an A+ in years 17 to 20. Next up, I'd like to take a look at our company's year-end stock prices. Looking at the chart, you could probably see that we struggled quite a bit from years 10 to 15, but after year 15, we figured out how to steadily increase our stock price and increased it steadily and quickly up until year 19, and then we plateaued again at year 20. Our lowest stock price was in year 10 where it landed at $30, which we did not expect. Our highest stock price was in year 19 when it was $809.47. Looking back, I do wish we were able to learn about the stock price a little bit quicker, and if we had, I think we would have been able to have a higher stock price earlier on. For our last financial trend, I would like to take a look at our company's annual image rating. Looking at the chart, you can see that in years 11, 14, and 19, we had a very slight decrease in our image rating. But for every other year, we were able to successfully increase our image rating. In fact, we achieved an image rating of 100 for 4 years during the time that we operated. Our lowest image rating was actually in year 11, and it was a rating of 69. I do feel like it took quite a while for us to figure out proper strategy to help increase our image rating, but in year 15 to 16, you can see that we were able to pretty much lock down our strategy for our image rating and keep it pretty steady until year 19, like I mentioned a bit earlier. Next up will be one of my co-owners, Brandon, and he will be speaking about our visions and strategies, and then he will pass it on to Chris.
Hello, Brandon Varnell, co-manager of Happy Feet. Today I'm going to be speaking with you about our strategic vision, our performance measures as far as the year 21 and 22 were expected to be. I'm also going to be speaking with you about the internet, wholesale, and private label market strategies and I'll finish with our production efficiency capabilities. So, Happy Feet, our strategic vision, what we strive to do year after year was achieve sustainable growth through customer satisfaction with keeping their feet happy and cost beneficial shoes that met a global demand. Happy Feet used a team of motivated individuals that most importantly cared about the community and the environment to put the most comfortable shoe on every foot possible. Just like our motto says, we like our feet like we like our wallets. Happy. As far as our predicted performance targets goes for year 21 and year 22, if the current corporate strategy is continued on earnings per share, return on equity, credit rating, image rating, stock price, I went ahead and followed the same process that we do with each year and the outcomes in Excel, and I came up with these numbers. It seemed like year 21, year 20 and 21 were really playing catch up from not being thorough in year 19 decisions. But year 22, you can see we were kind of back where we should have been with year 20. But overall, great numbers. Very excited and proud of this company and what we've been able to achieve. So for our internet, wholesale, and private label market strategies, they really mirrored our business strategy, which was to each year look at the prior numbers of the prior years and then make tailored decisions in each category to try and keep our moves per se unpredictable to our competitors, giving us a good competitive advantage. Nobody can predict what you're going to do. It's hard to mirror what you do. So year after year in our internet market, we tried to increase our profit margins $1 to $2. Once we felt confident enough, year 14 and 15, we jumped our prices $3 to $4 in each region. And as you can see, it behooved us. Year 18 and 19, we kind of slacked off as far as being very thorough and checking our processes before we hit the submit button. And I think that just comes as a learning curve. Overall, very happy with how we did in internet, wholesale, and private label. So our wholesale market strategy really mirrored our e-commerce strategy as far as year after year tailored, decisions to try and keep us in the competitive advantage. So for the wholesale market, we really tried to focus on our price to our retailers, the brand advertising, delivery time, mail and rebate, as well as our retailer support. We felt that brand advertising was more behooving to us than retailer support. So in the later years, we really started to focus more on that. I wish you would have in the beginning more. I think it would have behooved us more then, but it's a learning experience. And then as far as another avenue we pursued to maximize our overall sales was our celebrity appeal. Overall, the 4 regions, I think that year after year, we had a high celebrity appeal in each region. That's what really helped keep us competitive. And just like with the private label market, it mirrored the e-commerce and wholesale market strategies, where we felt that the high model number, the middle of the road SQ rating, as well as an affordable price, really is what attracted people to purchase our private label brand shoes, athletic wear. One of the things is that we really hit the private label from the ground running. Year after year, we felt like it was a good way to get a little bit of side cash. And then after we saw that the jump in year 14 to 15 in the internet market, as well as the wholesale market sales price, really behooved us. We felt confident enough to make that jump in our private label market, and it really behooved us there as well. So I would say as a whole, Happy Feet was very confident in sticking with our efforts with the private label market, and that's one of the things that kept us at a strong advantage against our other industry competitors. So with our production capability strategies, we really kept it aligned with our strategic vision year after year, making decisions based upon where we felt we needed to. In the very beginning, we kept production in North America and the Asia Pacific, and then we shipped it out to Europe and Latin America, and then we moved production there whenever we felt that our company was very ready to do it. And I think that the sales and our performance year after year really reflected that we made good decisions there. One of the things that we tried to do was keep our incentive pay up until the 25% mark of the overall total, compensation pay. And I think that's one of the things that helped us. And another thing, as far as overtime goes, in each specific region, we tried to keep that reserved for whenever more production was needed in a region, but it was more cost efficient to pay out overtime versus to raise production in a facility in a different region and then ship that product to the other region.
Hey guys, my name is Christopher White. I'm also a co-owner of Happy Feet, and I just wanted to jump in here and take over for Brandon talking about our production strategy a little bit more. And what I really want to focus on here is, when it comes to the plant capacity and the location, how did we decide to do what we were doing? How did we decide to grow? How did we decide to expand into other areas? And what that looked like from our point of view? We really focused on the fact of, how can we gain a competitive advantage? How can we get there before other people? How can we make a showing? How can we sell more shoes in those areas and just be kind of different than everybody else? Because we really felt like being different is where we were going to gain more business. When we took over in year 10, Happy Feet really focused on the fact of, we have equipment in North America and Asia Pacific, but what do we need to do with that equipment? We really decided to let's improve it. Let's make it the best it can be. Let's make it the most cost efficient it could be, and let's go from there. So we did that. After we improved that equipment, we jumped really quick on, what can we do in Europe, Africa? What can we do in Latin America? What does everybody else do? And we really focused on the end of the year reports, and we took into account what is everybody else doing and what can we do different, like I said before. So we did that, and we jumped in. We felt like we made a good showing. We showed good production in those areas. We really focused on trying to nail it home that we need to create, a low price shoe. That's where we wanted to focus on, is a low price shoe to the customer. So by doing that, we really had to make sure we cut costs. And by cutting costs, it's getting that equipment in those areas so we ain't having to pay to ship equipment, or ship shoes from one area production facility overseas, possibly to another production facility, and paying that extra cost. So by putting that equipment there, yeah, there's a little bit of cost up front, but long run, we've seen the big payoff was that we were able to cut costs so much that we can drop our price so low to be able to compete with everybody else. It was a perfect fit for Happy Feet, honestly. Hey, so looking at our finance strategy for Happy Feet, we really focus on the fact of, like, if we're going to go through this, we need to make sure we try to get these 10-year long-term loans and not really focus on getting a short loan, just so it took our availability and it spread it out longer, and we were able to pay less each year, you could say, and be able to take more money that we would be paying on these shorter loans, and we could take that money and we could actually continue to use it to grow our business, as well as how we took that loan money the first year and we grew it also. We like to take the loan money, and what we did, we really focused on, let's take this loan money, let's extend it out for 10 years, and let's improve our facilities. Like I said before, we want to improve our facilities, and then we were able to take that money and expand production capabilities to other regions as well, being Europe, Africa, and Latin America. And we really focused on that big time. From the very first year of ownership, we really focused on the fact that we need to try to buy back stock annually, but we need to do as much as possible early on because it's going to be the cheapest it's always going to be. And so we really try to hit that as well as we could. Of course, when you're trying to expand like we were and grow and be able to produce as many shoes as Happy Feet was producing, you can only do so much without really putting your company at risk. And so we felt like we found a happy medium in between of buying back a lot of stock and buying back none. We found that spot in the middle where we were comfortable, but at the same time, we did what we could do to make ourselves look the best and make investors happy. And so that's the approach we took when it comes to buying back stock. We really like to take into the effect of our credit rating. We met early on and decided our credit rating is going to be huge to us. We got to take a little bit of hit up front, of course, because we have to have loans. You cannot just run the kind of company we were wanting to run just based off no loans. And so we decided, yes, we got to do it, but let's try to get back on track as fast as possible and keep the train running in the right direction to have that good credit rating. We just really wanted to look good in our image rating area and show people that, we're just not a company that wants to go out and have a terrible credit rating and not care about what we look like and care about what kind of standing we're in with a bank to say. But at the same time, we had to take the loans in order to grow production, which is a given. And so we found that perfect balance that we felt like was the best area and the best fit for us, and that's what we ran with. Hey, so jumping in, let's look at our strongest competitors that we feel like we had in all three markets. You know, the internet market, the wholesale market, and also the private label market. We like to take into account what was our strongest competitor that we felt like. So we look at the internet market first. The strongest competitor would have had to been Company B as far as how strong they like to come on here and there. You know, the closest throughout the whole time, we'd have to look at Company J though. You know, and so going to the wholesale market, we're going to look at the strongest competitor we had probably in the wholesale area being Company I. Closest to us, we'd have to probably say is Company J also. Going over to the private label market, where we felt like there was more area that we could also grow in if we would have, you know, kept on moving forward probably. But the strongest that we seen was Company G, and then once again, as well as the other two markets, Company J was probably our closest competitor and really pushed us to be better than we could have been if we just wouldn't have focused. And so Company J was really right there at our heels, we felt. Hey, so let's take a look at our actions that we use to compete against rivals. Something we focused on is for sure, like we talked about before, is the production equipment and capacity that we had in areas. You know, we really focus on trying to find ways to cut production costs and at the same time improve worker productivity across all production facilities to be able to produce more shoes because that was our name of game that we tried to chase and what we tried to do as a company. The continued effort in increasing the number of resources allocated to search engine and brand advertising in all market segments was really big to us. We took into account of, you know, how can we really get our name out there? How can we really show people that we're here, that we care, that we want to produce a good shoe and meet their needs and wants, you know? And so we really focused on the brand advertising and the search engine, you know, that way people when they got on the internet and they typed in, you know, where can we find this? Like we popped up, we were there. We like to spend money on that because we wanted to be first in people's eyes when it come to that. Pursuing a strong brand presence in all four regions with the help from celebrity endorsements was a big deal to us also. You know, we felt like as we went on, we started off kind of slow in the celebrity endorsements, but we quickly realized how much it actually helped our business grow, helped our shoe look better with these celebrities, you know, maybe wearing them, maybe, you know, showing people that they endorse those shoes. And so we really seen that it really took a lot of effect and it really played a big role in us competing against our rivals in the shoe industry as well. An area that we really like to focus on that we had our most, I'd probably have to say our most gains as far as, you know, head over shoulders against our competition was how we handled our private label production. That was a big deal to us. You know, maybe the cost margin, you know, wasn't where we wanted it. You know, maybe our profit margin wasn't necessarily as pretty as the other areas, but we were able to sell a big number of shoes just because it was there. As a whole, we felt like the whole shoe, you know, environment as a whole, we really wasn't attacking that private label segment, and we were able to really see that and get a glimpse of what we could do to make it better and where we could really get in and just sell a bunch of shoes. And like I said, maybe the profit margin wasn't there, but we were able to produce. We were able to get it out there, which in the end made our revenue just skyrocket, and it really helped us get a big margin there as well. Hey, so finally, let's look at Happy Feet and the lessons learned through the 10 years of owning Happy Feet. A big important thing that we learned really quickly is you really have to pay attention and cross your T's and dot your I's of every opportunity that comes about. You know, year after year, when you get those financial reports, you really got to pay attention to what did our competitors do? You know, where did we fall short? What changes need to be made year by year? You know, we really needed to focus on how to improve our company, and at the same time, what is everybody else doing that's improving their company, so we can maybe take that into account but make our company even better, make it look even better in people's eyes, you know, make our profits better, make our shoe look better, you know, what makes our investors happy. And we really focus on the fact that we really have to pay attention. You know, also a big one that we learned was that you have to buy as much stock back as you can early on when the price is cheap, you know, which we've already talked about that, but early on the price is going to be cheap as it's going to be, and as the company grows, that price is just going to go up, and so it's going to get worse. It's going to get more costly to buy this stock back, and so in order to make our investors happy, we felt like that's what we had to do. That's when it was cheapest. That's what we had to focus on. The location of our warehouses and production facilities is another thing that we learned that was a big lesson of, you know, yeah, you know, when the money's not there, the production equipment's not in all the countries, yeah, we have to focus on the fact, okay, here we are. Let's make this shoe and we got to ship it. We got to pay that cost to ship it, but it is what it is. Let's get over there and make a showing. And then as we went on and the money became better for us to be able to spend money on the production equipment, then it became, okay, now we can cut our costs. Now we can add this equipment here and we can make this shoe there and we don't have to ship it and we don't have to pay that extra cost. Not being afraid to go into debt early on. Of course, that was a big thing that we had. When you first start, you're scared of the big thing of going in debt and not making that payment. And we were able to ease into that debt, but also at the same time we jumped in good enough that we could improve our company off of getting in debt, but then slowly working our way out of it. We had a good plan from the beginning. It's not like we just jumped in and said, okay, well, hope this works out. No, we kind of seen it before we said, okay, this is what we're going to do. We worked out what's the worst case possibility. What could happen worst case, and so now we're going to make it. We feel good about that. We kind of like to run off the slogan of, think worst but hope for the best, and that's what we feel like we did. Of course, a winning strategy is the one that must be completely analyzed and improved upon year after year after year. It's not one that you could just put into effect in the next year, just kind of be lazy with it and say, well, it worked last year, let's just like be easy with it and go on and not spend a lot of time with it and move on. No, we kind of realized, which just like anything else, you always got to be ready to change and you always got to be ready to improve and you always got to be looking at ways to keep moving forward and how to outbeat your competition. And so that's kind of some lessons learned. All of us here at Happy Feet, we thank you so much for paying attention to this and listening to us talk about how our business ran through these 10 years and what we learned and what we did and what we could have did different maybe and how we just got to here. And we just thank you a bunch and have a great day.